Hey Bowtie Nation, Joseph Hogue here. Thank you for joining us for another Monday market update, 9 a.m. Eastern, every Monday morning. Get you ready for the week, stocks to watch, and the economic news you need to see. And Nation, stop me if this sounds familiar. The stock market is going up. Everyone is happy, except you. Your stocks are falling. While it can be easy to chalk all this up to bad luck or some paranoid conspiracy that the market is out to get you, it could actually be a problem with your investing strategy. Either way, I know how much it sucks because I've been there before. Now, if you've ever bought a stock after the price fell, thinking it's a good company and just a matter of time before it bounces back, only to see it keep falling, I'm going to highlight why it happens and why instead of buying those bargain stocks, the better strategy may be to chase the ones that have already gone up. Stick around after that. We'll do our Monday market update with the stocks I'm watching this week. First though, the best strategy in the world is going to be pointless if you don't start with an investing plan right for you. That's why I created this quick 3-step guide to making your investing plan. Within 5 minutes, you'll be able to create an investing plan that makes your goals the motivation to keep investing and that is customized to your needs. I'll leave a link below in the description. It's totally free, just something I wanted to do for all you out there in the community. So click through, get your step-by-step guide now. Folks, I've seen way too many investors miss out on the opportunity to make their money work for them. It's because they didn't have a plan that fit their needs. So look for that link and get your free customized report. Back to our main topic though, and one of the worst investing strategies, the worst mistakes that lose your money, is buying into stocks that have fallen expecting a rebound. Now, I know the strategy seems to make sense. Once great companies that make a misstep, the price plunges and you're thinking you'll get a deal on the stock and wait for it to bounce back to its former glory. So you buy into the stock and you're already counting your profits as if it were to bounce back to that previous high. Then the stock keeps falling. That's fine. You buy more, you lower your cost basis, and you're expecting to get an even bigger return when the stock rebounds eventually. Because it has to rebound eventually, right? The worst is when the rest of the market is booming though. You sit there watching stocks hit new highs, all except for your stocks, and the wait becomes excruciating. Nation, we all have stocks where it has worked out this way. I'm no different, and this is probably the single biggest problem I need to work on in my own portfolio. While bargain hunting in stocks like DraftKings and Salesforce produced 100% plus returns over the last couple of years, I've also been burned by dogs like PayPal and Alibaba, both still waiting for that rebound. So I want to dig into why this strategy of buying cheap works for some stocks, but not for others, and why you're actually better off with the opposite strategy. And here, the nerdiest reason I can think of is Newton's first law, that a body in motion tends to stay in motion till a force acts upon it. In investing terms, a stock in free fall tends to keep falling until news comes around to turn it around. And of course, it's not that physics has anything to do with stock prices. Newton himself famously lost the equivalent of $4 million in the South Sea bubble. But there is a very good reason for that momentum in stock prices, that idea that falling stocks tend to keep falling, and that those with rising stock prices keep running. And it's because that underlying reason for the stock price that's falling or rising isn't something that's going to change quickly or easily. A company losing its market share or with bloated operational costs that are just destroying profitability, it isn't likely to change those problems overnight. Conversely, a company with a competitive advantage that is taking customers away from its legacy peers or is hooked into a developing trend, it's likely to keep enjoying that updraft in the price. Now, there is a proven momentum in stock prices. Backtested results over the 12-year period to 2011 show stocks that saw price increases in the previous 6 or 12 months saw their price continue to increase over the subsequent period. Here we see the top 20% of stocks by price increases in that quintile 1. The top 20% of stocks with their price increasing produced follow-on returns from 150 to as high as 285%. While those in the bottom 20%, so the quintile 5 stocks that saw their prices fall in the test period, continue to fall as much as 80 and 90% over the next period. More recently, the iShares Momentum Factor ETF, ticker MTUM, a fund that tracks this momentum in stocks, has produced a 191% return since its 2013 inception. Now that is close to the same return as the broader S&P 500 over that whole period, but looking at the chart, you notice the momentum fund outperformed by a wide margin in the bull market through to 2021. It's only in the bear market of the last few years that momentum strategy is broken down. Normally, especially in bull markets, it is a very strong factor. Now, pure momentum investing is based on technical signals where you just follow price charts on a stock, and that alone determines what you buy and sell. Now, that is not what I'm suggesting you do here, though. While I use a few technical signals to help guide my investing decisions, more than anything, I'm still using and analyzing a company's fundamentals and buying quality companies for their long-term earnings growth. What I do think you can take away from this is to use that idea of momentum as a factor in which stocks you buy and when. When a stock sees a big drop in the price or falls over a period, really think objectively about why the price is falling. Look for those bear case articles describing the problems. If it's a fundamental problem with how the company competes or its profitability, then that's not something that is going to get solved quickly. Using PayPal as an example, shares reached a peak around June 2021 when eBay started to transition away from using PayPal as its de facto payment service. The stock has also come under pressure as Apple takes more of its payment market share. While PayPal is still the leader in the space, neither of these problems are something that can be solved quickly, so there's no reason to jump in as the stock came down. I started investing February 2022 at $97 a share, thinking that the 66% crash in the price already made it a steal of a bargain, but it didn't give those big fundamental problems their due. Through some dollar cost averaging over the last 2 years, my cost basis is down around $80 a share, but that's still a 26% loss, and last week's earnings proved the company isn't yet ready to turn it around. On the other side of this, as I highlighted in a video on cybersecurity stocks last week, it can be difficult for value investors to jump into stocks that have already run higher and are trading expensively compared to others, but that momentum is going to work in their favor as well. Cybersecurity stocks relentlessly trade for prices 50 times their earnings, with some up at PE ratios of 100 times and more, something that seems ridiculously expensive when you compare them to other stocks trading at 10 and even 20 times earnings, but there is real momentum in that trend to higher cybersecurity spending. Cloudflare itself shocked the market last week, jumping 20% on its earnings call and is up 36% since the beginning of just this month. Now, there are some rules here you can follow to help you be a better investor. First is, again, just looking further into those stocks that have fallen, then just comparing the drop in price with that previous high and thinking it's eventually going to get back there. Really research the causes of that drop in the shares. Is it an industry-wide problem like maybe Albemarle with falling lithium prices that have destroyed its revenue growth? Is it a stagnant economy plus competitive pressures as in the case of Alibaba? Then ask yourself, how likely is it that those factors can be reversed and what's the catalyst for that? When does that happen? If consumer demand for electric vehicles is slowing, that's going to keep pressure on those lithium prices, especially after years of supply growth like we've seen. Also, you can set formal time or percentage limits for when you reinvest in that stock. I know it can be painful to watch a stock you own fall further. The temptation to buy more shares and lower your average cost is immense, but jumping in to buy more shares every time the price drops just means you're going to lose more as the stock continues lower. Instead, when you do start buying into a stock, you think it's going to rebound, do not buy more shares before giving it at least maybe 3 or 6 months. You can still dollar cost average, buying more shares at that lower price, but give it more time before following it lower. In fact, following that idea of momentum investing, waiting for a stock to start turning around and then buying more as it heads higher, it's really probably going to be your best strategy. I know this isn't an easy strategy to follow. It's subjective because you have to do that research and the analysis into a stock, but Nation, this is how you become a better investor. This is how you pick those stocks that are going to do well and avoid the ones that are going to lose your money. Now I want to turn it over to some of the stocks I'm watching this week. First up, Penn Entertainment, ticker PENN. It's scheduled to report its earnings Thursday with a stock up 26% since highlighting it in a video late October on that tie-up deal with ESPN. Now, what revenue growth this year is expected to be an anemic 1.7% growth, and earnings are still going to be negative. I still like the stock on that potential around ESPN Bet. Now, Disney is up 35% since recommending it in that same video and recently announced a landmark deal between ESPN, Fox, and Warner Brothers, which should strengthen that asset, the ESPN, and it's going to help drive gaming revenue for Penn. Coinbase Global, ticker COIN, is also scheduled to report its earnings on Thursday with shares down 19% since mid-December, really leading up to that approval of spot Bitcoin ETFs. Now, while the shares have clawed back some of those January losses, it isn't clear yet how Coinbase is going to compete for investors now that there are lower cost ETF options. Of course, Kathy Wood of ARK Invest continues to be a believer, making Coinbase her top position within the ARKK fund at 8.7% weight, but the company is just going to need to offer more to persuade those retail investors to hold crypto directly instead of in a fund. New York Community Bank Corp, ticker NYCB, has fallen more than 50% in just the last 2 weeks on that real estate loan losses, higher loan loss reserves, and increased capital reserve requirements for being a larger bank, but may have turned momentum Friday. The shares spiked 17% when it was reported that 3 directors, including their new chairman, Alessandro Dinello, bought more than $330,000 worth of stock. The bank hasn't seen the same kind of deposit flight that killed those 3 banks last year and appears to have enough reserves to cover any potential losses. But if you want some safer options, I also highlighted 5 safer bank stocks in a video last week. I'll link to that in the description. Showing you that bigger picture idea here with the sectorspiders.com sector tracker. We do see that 7 of the 11 stock sectors closed higher last week, with tech stocks once again leading the market, but with surprisingly strong gains in industrials, healthcare, and consumer discretionary as well. While the increase in interest rates didn't dent that overall market run, it has caused more pain in those dividend sectors we've been watching, those utilities, consumer staples. With hopes of a rate cut being pushed back, investors are once again looking for those yields in bonds and money markets instead of these dividend stocks, so those probably will likely stay under pressure for a while. I highlighted the strength in consumer discretionary stocks last week on that continued trend in consumer spending, and 36 of the 53 names in the sector traded higher last week. The sector is lagging year to date only because Tesla is 13.8% of the sector weighting. That's down 22%, while more than half, 29 stocks in the group, are actually up for the year. Travel and gambling stocks continue to do well. We see here Wynn Resorts, Marriott, Las Vegas Sands, and Airbnb are all in the top 10 performers, while cruise lines and apparel continues to struggle, with all 3 cruise stocks within the bottom 10 laggards for the sector. As we head on into this week, though, folks, stocks are undeniably expensive. That 40% run in the S&P 500 since the October 2022 low has taken stocks in the index to a price of 20.3 times the earnings analysts expect the companies to report over the next year, that forward PE ratio. That's nearly 15% more expensive than the average forward PE ratio of 17.7 times over the last decade, and even more compared to the 25-year average at 16 times price to earnings. But we know stocks don't fall just because they get expensive. They always need a catalyst to send them lower. And as long as that pace of inflation continues to moderate and the economy stays strong, stocks are likely to march higher. Now, we're going to get data to confirm both of those points this week, as Tuesday is going to bring the monthly CPI, the Consumer Price Index measure of inflation. Expectations are for consumer prices in January to have increased 2.9% from the last year. That's compared to a pace of 3.4% over the year through December, so that is slowing there. That slower inflation could continue that multi-month trend, and that is confirmed last month in the PCE report, showing the annual inflation is actually now really close to the Fed's target rate. We're also going to see retail sales data on Thursday, with expectations for the headline number, the headline sales, to have fallen 0.2% last month. That would be versus a gain of 0.6% in the previous month. Excluding those volatile auto sales, though, the monthly figure comes to a gain of about 0.3%, only slightly lower than the 0.4% gain in December, and still showing that strong consumer spending trend. Get your personalized investing plan with the link below, and make sure your stocks fit your goals. Or click on the video to the right for my complete 2024 investing plan and the stocks I'm buying right now. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.